Hello and welcome to lecture number 9. There is no lecture number 8 because that was the week of your midterm exam. So this is lecture number 9 of Stat 761. So we will be talking about options markets. So we begin by sharing the screen. So we will talk about the mechanics of options markets. So we introduced options, what they are, etc. back in chapter 1. This chapter explains how options markets are organized, what terminology is used, and how the contracts are traded, how margin requirements are set, and so on. Later chapters examine such topics as trading strategies involving options, the determination of option prices, and the ways in which portfolios of options can be hedged. This chapter is concerned primarily with stock options. It also presents some introductory material on currency options, index options, and futures options. Options are fundamentally different from forward and future contracts. An option gives the holder of the option the right to do something, but the holder does not have to exercise this right. By contrast, in a forward or futures contract, the two parties have committed themselves to some action. It costs a trader nothing except for the margin and collateral requirements to enter into a forward or futures contract, whereas the purchase of an option requires an upfront payment. When charts showing the gains or loss from options trading are produced, the usual practice is to ignore the time value of money so that the profit in the final is the final payoff minus the initial cost. This chapter follows this practice. Okay, so let's see. So as mentioned in chapter 1, there are two types of options. A call option, which gives the holder of the option the right to buy an asset by a certain date for a certain price. A put option that gives the holder the right to sell an asset by a certain date for a certain price. The date specified in the contract is known as the expiration date or the maturity date. The price specified in the contract is known as the exercise price or the strike price. Options can be either American or European, a distinction that has nothing to do with geographical location. American options can be exercised at any time up to the expiration date, whereas European options can be exercised only on the expiration date. Most of the options that are traded on exchanges are American. However, European options are generally easier to analyze than American options, and some of the properties of an American option are frequently deduced from those of its European counterpart. So we see here, this is the profit from buying a European call option on one share of stock. So the option price is $5, so it costs an initial $5 to buy it, and then the strike price is 100. So once you go above 100, you end up making the difference between the value of the stock minus the strike price, which of course is a linear function. Okay, so consider the situation of an investor who buys a European call option with a strike price of 100 to purchase 100 shares of a certain stock. Suppose that the current stock price is $98, the expiration date of the option is in 4 months, and the price of an option to purchase one share is $5. The initial investment is $500. Because the option is European, the investor can exercise only on the expiration date. If the stock price on this date is less than 100, the investor clearly chooses not to exercise. There is no point in buying for $100 a share that has a market value of less than $100. In these circumstances, the investor loses the whole of the initial investment of $500. If the stock price is above $100 on the expiration date, the option will be exercised. Suppose, for example, that the stock price is $115. By exercising the option, the investor is able to buy 100 shares for $100 per share. If the shares are sold immediately, the investor makes a gain of $15 per share, or $1,500 ignoring transaction costs. When the initial cost of the option is taken into account, the net profit to the investor is $1,000. So figure 10.1 right here shows how the investor's net profit or loss on an option to purchase one share varies with the final stock price in this example. For instance, when the final stock price is 120, the profit for an option to purchase one share is $15. And we can see this $15 from over here, from the graph. It is important to realize that an investor sometimes exercises an option and makes a loss overall. Suppose that in the example, the stock price is 102 at the expiration. The investor would exercise for a gain of $2 per option and realize a loss overall of $3 when the initial cost of the option is taken into account. It is tempting to argue that the investor should not exercise the option in these circumstances. However, not exercising would lead to a loss of $5, which is worse than the $3 loss when the investor exercises. So you see, if it's 102, we are in this case, so we are at -3. Okay. It is tempting to argue that right. However, not exercising would lead to a loss of $5, which is worse than the $3 loss when the investor exercises. In general, call options should always be exercised at the expiration date if the stock price is above the strike price. So for put options, whereas the purchaser of a call option is hoping that the stock price will increase, the purchaser of a put option is hoping that it will decrease. Consider an investor who buys a European put option with a strike price of $70 to sell 100 shares of a certain stock. Suppose that the current stock price is $65. The expiration date of the stock is in 3 months, and the price of an option to sell one share is $7. The initial investment is $700. Because the option is European, it will be exercised only if the stock price is below $70 on the expiration date. Suppose that the stock price at that time is $55 on this date. The investor can buy 100 shares for $55 per share, and under the terms of the put option, sell the same shares for $70 to realize a gain of $15 per share, or $1,500. Again, transaction costs are ignored. When the $700 initial cost of the option is taken into account, the investor's net profit is actually $800. It's $1,500 minus $700. There is no guarantee that the investor will make a gain. If the final stock price is above $70, the put option expires worthless and the investor loses $700. So figure 10.2 shows the way in which the investor's profit or loss on an option to sell one share varies with the terminal stock price in this example. So early exercise, as mentioned earlier, exchange-traded stock options are usually American rather than European. This means that the investor in the foregoing examples would not have to wait until the expiration date before exercising the option. We will see later that there are some circumstances when it is optimal to exercise American options before the expiration date. So, option positions. There are two sides to every option contract. On one side is the investor who has taken the long position, has bought the option, and on the other side is the investor who has taken a short position, i.e. has sold or written the option. The writer of an option receives cash upfront but has potential liabilities later. The writer's profits or loss is the reverse of that of the purchaser of the option. So figures 10.3 and 10.4 show the variation of the profit or loss with the final stock price for writers of the options considered in figures 10.1 and 10.2. So we see this is the profit from writing a European call option on one share of a stock. So it is at $5 per share, as you can see, up until the strike, which is 100, and then it falls linearly instead of increasing linearly. So it's the reverse of what we see in figure 10.1. It's the exact reverse of that. The reflection of this graph with respect to the x-axis is what the profit of a writer of a call option is. So there are 4 types, and similarly for 10.4, this is the reflection with respect to the x-axis of 10.2, which is over here. And what you see over here is that you gain $7 per share if the strike is above $70, and you lose linearly going down if the stock price, the underlying stock price, falls below $70. So there are 4 types of options positions, and they are a long for position in a call option, a long position in a put option, a short position in a call option, and a short position in a put option. It is often useful to characterize a European option in terms of its payoff to the purchaser of the option. The initial cost of the option is then not included in the calculation. If K is the strike price and ST is the final price of the underlying asset, then the payoff from a long position in a European call option is the maximum of ST minus K and 0. As you can see it here as well in graph A, the maximum of ST minus K and 0. This reflects the fact that the option will be exercised if ST is greater than K and will not be exercised if ST is less or equal to K. The payoff of the holder of a short position in the European call option is basically the reflection of this graph with respect to the x-axis, which we see over here. B is a short call, So you see that the graph in part B is the reflection of the graph in part A with respect to the x-axis. It's the short call, okay? So it's minus the maximum of ST minus K, and it is the minimum of K minus ST and 0. The payoff of the holder of a long position in a European put option is the maximum of K minus ST, which is over here. It's in part C of this graph. And the payoff of a writer of a put option is basically the reflection of that with respect to the x-axis, which we see over here, and is basically minus the max of K minus T, which is the minimum of ST minus K. So the underlying assets, this section provides a first look at how options on stocks, currencies, and stock indices and futures are traded on exchanges. So here we're going to talk about exchanges, but before we do that, let's go to our slides. So these are our slides over here. So the review of option types, there is a call is an option to buy, a put is an option to sell, a European option can be exercised only at the end of its life, an American option can be exercised at any time. That's it. And the option positions are long call, long put, short call, and short put. So this is a long call graph. The profit from buying one European call for option price $5, the strike price is $100. The option life is 2 months, and you see that you have minus $5 up until you reach 100, and then the profit increases linearly as the stock price rises, right? And this is the profit of writing one European call option, which is basically the reflection of this graph with respect to the x-axis. And so you make $5 per share up until the stock price reaches 100. If the stock price goes beyond 100, then you are supposed to sell at 100, and so you lose going down linearly. You're supposed to sell to the person whom you wrote the call to, because you wrote the call here. A long put is basically the profit from buying a European put option. So the option price is at $7, the strike is at $70. You see that your profit increases, is stuck at, it's minus $7 for buying the option if the stock price is above the strike price, and it increases linearly if the stock price is below the strike price. And the reflection of that is the profit from writing a European put option, where you make $7 per share if the stock price is above the strike price, and you basically have to cover your position of writing the put option if the stock price is below $70. So these are the payoffs from options. So what is the option position in each case? As you can see, this is the payoff of taking a long position in a call option. This is the payoff of writing a call option. This over here is the payoff of buying a put option, and this is the payoff of writing a put option. So assets underlying exchange traded options. So what are those? Let's go back to the book and discuss those. So let's go back to sharing the screen. So now we're going to talk about underlying assets. So this section provides a first look at how options on stocks, currencies, stock indices, and futures are traded on exchanges. So stock options, most trading in stock options is on exchanges. In the United States, the exchanges include the Chicago Board Options Exchange, the NYSE Euronext, which acquired the American Stock Exchange in 2008, the International Securities Exchange, and the Boston Options Exchange. Options trade on several thousand different stocks. One contract gives the holder the right to buy or sell 100 shares at the specified strike price. This contract size is convenient because the shares themselves are usually traded in lots of 100. So ETP options, the CBOE, the Chicago Board Options Exchange, trades options on many exchange traded products. So exchange traded products are listed on an exchange and traded like a share of a company stock. So they are designed to replicate the performance of a particular market, often by tracking an underlying benchmark index. ETPs are sometimes also referred to an exchange traded, exchange traded vehicles. The most common ETP is an exchange traded fund. This is usually designed to track an equity index or a bond index. For example, the SPDR S&P 500 ETF Trust is designed to provide investors with the return they would earn if they invested in the 500 stocks that constitute the S&P 500. Other ETPs are designed to track the performance of commodities or currencies. Foreign currency options. Most currency options trading is now in the over-the-counter market, but there is some exchange trading. Exchanges trading foreign currency options in the United States include NASDAQ OMX, which acquired the Philadelphia Stock Exchange in 2008. This exchange offers European-style contracts on a variety of different currencies. One contract is to buy or sell 10,000 units of a foreign currency, which is 1 million units in the case of the Japanese yen for US dollars. Foreign currency options contracts are discussed further in Chapter 17. Index options. Many different index options currently trade throughout the world in both the over-the-counter market and the exchange-traded market. The most popular exchange-traded contracts in the United States are those on the S&P 500 index, the S&P index, the NASDAQ 100 index, the Dow Jones Industrial Index. All of these trade on the Chicago Board Options Exchange. Most of the contracts are European. An exception is the OEX contract on the S&P 500, which is American. One contract is usually to buy or sell 100 times the index at the specified strike price. Settlement is always in cash rather than by delivering the portfolio underlying the index. Consider, for example, one call contract on an index with a strike price of 980. If it is exercised when the value of the index is 992, the writer of the contract pays the holder 992 minus 980 times 100, which is $1,200. Index options are discussed further in Chapter 17. Futures options. When an exchange trades a particular futures contract, it often also trades American options on that contract. The life of a futures option normally ends a short period of time before the expiration of trading in the underlying futures contract. When a call option is exercised, the holder's gain equals the excess of the futures price over the strike price. When a put option is exercised, the holder's gain equals the excess of the strike price over the futures price. Futures options contracts are discussed further in Chapter 18. So let's go back to our book and look at a summary of that, to our slides and look at the summary of that. So we see, so the assets, So assets underlying the exchange traded options are stocks, they are ETFs, they're foreign currency, they're stock indices, and they're futures contracts. So let's stop sharing for a second. So we resume here. So we have the specification of exchange traded options. Hold on, that we need to discuss. Give me one moment. So share the screen. So the specification of stock options in the exchange happens in the following way. So we will discuss that. In the rest of this chapter, we will focus on stock options. As already mentioned, the standard exchange traded stock option in the United States is an American style option contract to buy or sell 100 shares of the stock. Details of the contract, the expiration date, the strike price, what happens when dividends are declared, how large a position investors can hold, and so on, are specified by the exchange. So expiration dates, one of the items used to describe a stock option is the month in which the expiration date occurs. Thus, a January call trading on IBM is a call option on IBM with an expiration date in January. The precise expiration date is the third Friday of the expiration month, and trading takes place every business day, 8:30 to 3 p.m. Chicago time, until the expiration date. Stock options in the United States are on a January, February, or March cycle. The January cycle consists of the months of January, April, July, and October. The February cycle consists of the months of February, May, August, and November. And the March cycle consists of the months of March, June, September, and December. If the expiration date for the current month has not yet been reached, options trade with expiration dates in the current month, the following month, and the next 2 months in the cycle. If the expiration date of the current month has passed, options trade with expiration dates in the next month, the next but 1 month, and the next 2 months of the expiration cycle. For example, IBM is on a January cycle. At the beginning of January, options are traded with expiration dates in January, February, April, and July. At the end of January, they are traded with expiration dates in February, March, April, and July. At the beginning of May, they are traded with expiration dates in May, June, July, and October, and so on. When one option reaches expiration, trading in another is started. Longer-term options, such as LEAFs, long-term equity anticipation securities, also trade on many stocks in the United States. These have expiration dates up to 39 months into the future. The expiration dates for LEAFs on stocks are always the third Friday of a January. Strike prices. The exchange normally chooses the strike prices at which options can be written so that they're spaced $2.50, $5, or $10 apart. Typically, the spacing is $2.50 when the stock price is between $5 and $25, $5 when the stock price is between $25 and $200, and $10 for stock prices above $200. As will be explained shortly, stock splits and stock dividends can lead to non-standard strike prices. So when a new expiration date is introduced, the 2 or 3 strike prices closest to the current stock price are usually selected by the exchange. If the stock price moves outside the range defined by the highest and lowest strike price, trading is usually introduced in an option with a new strike price. To illustrate these rules, suppose that the stock price is $84 when trading begins in the October option. Call and put options would probably first be offered with strike prices of $80, $85, and $90. If the stock price rose above $90, it is likely that a strike price of $95 will be offered. If it fell below $80, it is likely that a strike price of $75 would be offered, and so on. So the terminology: for any given asset at any time, many different option contracts may be trading. Suppose there are 4 expiration dates and 5 strike prices for options on a particular stock. If call and put options trade with every expiration date and every strike price, there are a total of 40 different contracts. All options of the same type, calls or puts, on a stock are referred to as an option class. For example, IBM calls are one class, whereas IBM puts are another class. An option series consists of all the options of a given class with the same expiration date and the same strike price. In other words, it refers to a particular contract that is traded. For example, IBM 160 October 2017 course would constitute an option series. Options are referred to as in the money, at the money, or out of the money. If S is the stock price and K is the strike price, a call option is in the money when S is greater than K, at the money when S is equal to K, and out of the money when S is less than K. A put option is in the money when S is less than K, at the money when S is equal to K, and out of the money when S is greater than K. Clearly, an option will be exercised only when it is in the money. In the absence of transaction costs, as an in-the-money option will always be exercised on the expiration date if it has not been exercised previously. The intrinsic value of an option is defined as the value it would have if there were no time to maturity, so that the exercise decision had to be made immediately. For a call option, the intrinsic value is therefore the maximum of S minus K and 0. For a put option, it is the maximum of K minus S and 0. And in the money American option must be worth at least as much as its intrinsic value, because the holder has the right to exercise it immediately. Often it is optimal for the holder of an in the money American option to wait rather than exercise immediately. The excess of an option's value over its intrinsic value is the option's time value. The total value of an option is therefore the sum of its intrinsic value and its time value. Flex options. The Chicago Board Options Exchange offers flex, short for flexible options, on equities and equity indices. These are options where the traders agree to non-standard terms. These non-standard terms can involve a strike price or an expiration date that is different from what is usually offered by the exchange. They can also involve the option being European when they're normally American or vice versa. Flex options are an attempt by option exchanges to regain business from the over-the-counter markets. The exchange specifies a minimum size, 100 contracts, for flex option trades. So other non-standard contracts include actual weeklies, binary options, credit event binary options, and doom options, which we will discuss in a second. Let's go back to our slides. So the specification of exchange-traded options basically specify the expiration date, the strike price, whether they're European or American, and whether they are call or put. And we've seen option class and option series. The terminologies, it can be at the money when S is equal to K, in the money when S, so it depends on whether it is a call, or if it's a call, it's in the money if S is greater than K, and it's out of the money if S is less than K. So there is an option class, an option series, which we just discussed, an intrinsic value, and the time value. And so now we're going to talk about other Chicago Board Options Exchange products, flex options, weeklies, binary options, credit event binary options, and doom options. So let's go back to the book. So weeklies, these are options that are created on a Thursday and expire on Friday of the following week. Then there is binary options. These are options that provide a fixed payoff of $100 if the strike price is reached. For example, a binary call with a strike price of $50